Welcome back, investors. Thank you for joining me for this deep dive into NVIDIA. We're going to be doing a full business analysis as well as an equity valuation for the fiscal year of 2025. I am your analyst for today, Jacob Geiger. All my spreadsheets and my thesis PDF will be in the description below, along with all of the sources. This video is not catered only to financial professionals, but for anybody who wants to learn how to do equity analysis and learn more about how to make smart decisions when investing. This is our agenda for today. I'm going to be running through a summary of action to give my recommendation on the stock, as well as my projected stock price and its potential upside, as well as a company overview, looking at its fundamentals. We'll go through competitive advantages. We'll be going through the potential issues that are impacting the stock price, as well as my investment thesis for why I think it will grow in the future or why I think it will not, as well as wrapping it up with a financial analysis and evaluation. Nothing in this video is to be taken as financial advice. I am not your financial advisor. You should invest at your own risk. You should know your risk tolerance, and I am not to be held liable for any losses you incur. So I do recommend an analyst rating of buy, as I looked at the cash flows of the company and projected the value to be worth around $143.53, with a potential upside of 6.76%. Some of the factors, but not all of them, that I believe are impacting the stock price to make it undervalued include the economic uncertainty right now, the current US political environment, as well as recent news. NVIDIA is broken down into two reportable segments that they report on their 10K, including compute and networking at 77.8% of their revenues, and graphics contributing 22.2% to their annual revenues. NVIDIA serves four primary markets that are within these two sectors, which include data center, gaming, professional visualization, and automotive. Some risks, but not all, include macroeconomic volatility, secular changes in consumer preferences, headline risk, foreign exchange and political risk, rising tariffs, antitrust regulation, and disruptive competition. NVIDIA has a market cap of $3.427 trillion, as well as nearly 25 billion shares outstanding. Their largest market is data center, making up around 78% of their annual revenues. Data centers started to become popular after the dot-com boom, where people wanted to get more online and there was a lot more data to be stored. Companies opted to build these large warehouses of servers where they can store all of their information in one place. Fast forward to the 2000s, where we now have cloud computing, where people can rent the hardware from data centers to complete complex computations and receive the results afterwards. This is the same technology that we use today for AI, as AI is very compute heavy and very hardware intensive. Where NVIDIA comes into play is they create the entire platform to make these data centers possible. They create the GPUs, or graphical processing units, that are capable of parallel processing to compute multiple tasks at one time, which is different from a CPU, or a normal computer processing unit, that can only do one task at a time. We can see in the chart down here that the latest NVIDIA GPU is up to 18 times faster than any CPU. NVIDIA at the moment has two notable architectures of GPUs. They have the Hopper system, and now they have the Blackwell system. The Hopper architecture is last generation, while Blackwell is the latest architecture that was just released in Q4 of 2024, not yet accounted for in NVIDIA's financials. The Blackwell architecture provides a 30 times performance boost, as well as a 3.5 times reduction in cost and energy consumption. On top of developing the hardware for these data centers, they also developed the software that works exclusively with their hardware. CUDA is an integrated driver that you can install within these GPUs that allows them to do this parallel processing. This platform is exclusive to NVIDIA GPUs, as it takes commands and computations and feeds it into the GPU according to its hardware setup. NVIDIA has designed this system from the ground up to ensure it all works seamlessly and efficiently. NVIDIA's full stack approach can be seen throughout all of their sectors and throughout everything that they do, and really demonstrates the complete knowledge that they have over their domain and industry. This allows them to not only have complete control over their development process, but also know every single weak spot of the development process and what they can improve next. More on that later. Their second largest market is gaming at 17.15% of revenue, which has been for the longest time their largest segment. This is what they grew brand loyalty from. As the name implies, these graphics cards were originally made to generate graphics in real time. The CUDA platform is designed to take non-graphical computations and perform those in parallel processing. But these GPUs were designed to compute graphics simultaneously. On top of CUDA, NVIDIA's support for gaming and integrated software for gaming has been widely received as some of the best in the market, including RTX, DLSS, and VSync. RTX is proprietary software built within the GPU itself, which allows for real-time ray tracing, which is the simulation of light within games. This gives a much more realistic render and is something that other graphics cards cannot reproduce very well or as fast. DLSS, or deep learning supersampling, allows the GPU to take a screenshot of the current frame, send it to an AI, have it generate the next 4 frames, and display that for the user to see. This reduces the number of frames the GPU physically has to render in real time and can synthetically boost frame rates up to 4 times. Lastly, we have VSync, which NVIDIA has partnered with multiple game development companies to include this option within the settings of video games, which allows you to sync your monitor's refresh rate with your GPU's frame rate to reduce screen tearing and offering a better, smoother gaming experience. And all these platforms, again, will only work with NVIDIA hardware, something to consider. The third largest segment being professional visualization, making about 2.5% of their revenues, includes 3D modeling, CAD software, manufacturing, architecture planning, and general professional workspaces. GPUs are the most important piece of the puzzle here, as to generate all the polygons required to develop a mechanical designed item within 3D software is very graphically intensive, as you have to make edits in real time, and there's no predicting the next frame. You have to predict it accurately and display it faithfully down to the very second. So with the increased performance of these GPUs, NVIDIA is allowing these companies to edit videos faster, design faster, and an all-around more efficient workflow. Their smallest market, being automotive and manufacturing, only generates about 1.8% of their annual revenues. So one way to go about computing is to send off your computational queries to a data center and then have it return its response, or you can compute it on site with a smaller supercomputer, if you will. NVIDIA's main contribution to the automotive industry is the Drive platform and NVIDIA Cosmos. The NVIDIA Drive platform allows these car manufacturers to implement AI driver assistance as well as fully autonomous driving. NVIDIA Cosmos is different. It's the first world foundational model, as they call it, and allows you to train an AI in a virtual environment without having to put it on the road per se. It is an AI model that has an extremely advanced understanding of real-world physics, light refractions, has object permanence, and can understand traction, weather conditions, different lighting conditions, and can train these AI models in a virtual environment that's entirely simulated but is one-to-one to real life. This also allows physical AI, such as robotics, to 3D scan their environment and put themselves within a virtual environment and can map out different simulations simultaneously and pick the best path to their desired result. On top of all this, NVIDIA Cosmos is entirely open license, so anybody can access this. It's one of the few platforms that they have released for others to see the source code of. To look at NVIDIA's competitive advantages, I'm going to be performing a Porter's 5 forces. The threat of new entrants into the tech sector is very low, as it requires a lot of money, technical expertise, and you need access to very advanced fabrication facilities that are not very common. NVIDIA has partnered with TSMC, or Taiwanese Semiconductor Manufacturing Company, to make sure they have consistent supply chain and manufacturing needs, and it's something that you cannot do without. There are very few fabrication facilities that have the technical expertise and know-how to create the chips advanced enough to compete with NVIDIA. Additionally, after you got the hardware piece down, you would also need to compete in the software industry, as NVIDIA has their own proprietary software that does not work with your own hardware. Not only that, but NVIDIA has a great reputation and their brand is very well known within the community. There's also some regulatory challenges with the US tightening its exports on these super chips, specifically to regions such as Russia and China, and have increased the licensing requirements, which just inevitably increases the compliance costs of participating in the industry. The bargaining of supplier powers is pretty high. TSMC is one of the few manufacturing sites that are capable of producing these chips, and they can have reasonably some power to set the prices in their favor. NVIDIA has mitigated this by doing long contracts and is also vertically integrated to have control over every last process within their supply chain and research and development. The threat of substitutes is very low, as there's very few options that compete with NVIDIA's performance. Not only that, but NVIDIA also provides very seamless workflows. Their CUDA, the RTX, and the DLSS come pre-installed sometimes, and in most cases it's plug and play, whereas for other companies you would need to find a way to manipulate CUDA to work with your hardware. And additionally, as most people do use NVIDIA hardware, there's a lot more support and there's a lot more of a community to help you out when troubleshooting. Lastly, there are very high switching costs. On top of CUDA, NVIDIA has also developed a software library called CUDA-X, which allows software developers to build their software around CUDA to make it work more efficiently with NVIDIA hardware. So if there was a new type of chip that came out, such as quantum computing, all of these software developers would have to go back into their code and optimize it for this new hardware. This is something that would be very expensive and just adds to the mental block of switching. For industry rivalry, it's slim to none. The top competitor being AMD only controls about 10% of the GPU market share. This is largely due to the fact that AMD is nowhere near the performance level of NVIDIA when it comes to data center chips, and NVIDIA has extraordinarily low operating costs as they control most of their supply chain. This is something we'll touch on later. The bargaining power of buyers is slim to none. There's many different clientele across all of their markets that we previously listed that are willing to buy with NVIDIA. So if someone does not like the price, there's probably someone else willing to buy the product. This is because there's very low leverage within NVIDIA's ecosystem. On top of this, NVIDIA is the leader when it comes to AI acceleration and real-time renders. NVIDIA's market share is actually growing year over year from Q3 2023 to Q3 2024. So now here are some of the issues impacting the stock price. The economic conditions of the US right now is not looking too great. We're entering a post-election year. If the economy follows the political cycle, which historically it does, we're going to see some contractionary events happen over 2025. This leaves a bad taste in investors' mouth, and they're usually willing to move their money over to the debt market and into bonds. This is compounded with the fact that the S&P 500's PE ratio is above its 10-year median, insinuating that it is overpriced. More on that later. Recent news brings up the release of DeepSeek R1, which was released by the Chinese hedge fund Highflyer, which they said that they produced this AI model that competes with ChatGPT o1, OpenAI's flagship model, for 27 times cheaper than what OpenAI spent to develop their model. This raised a very red flag to investors saying, hey, we're spending money kind of willy-nilly. What are we doing? So naturally, investors pulled their money out of the tech industry, and NVIDIA saw a decline of 18.85% in their stock price over the course of 4 days. I believe this was definitely an overreaction from people who don't know too much about AI. As DeepSeek R1 suggests, this is a reasoning model. These new reasoning models generate 3 times the amount of words it takes for it to respond. So now, while these models are smarter and they're performing better on benchmarks, you can wait up to a minute of it thinking through your prompt before it actually responds to you. If anything, this will increase the demand for faster GPUs and more efficient GPUs, as we're now demanding more and more tokens to be generated per second, which NVIDIA is positioned perfectly to supply. They are the current leader in performance by a long shot. As it currently stands, these reasoning models are useless for conversational AI, where you need to speak with an AI and have it respond in real time. You can wait up to a minute before it responds to you, making it not too great for these applications. Next, we have Trump's political environment. As we saw with Trump's tariff blitz, he signed 47 executive orders within the first 14 days of him being in office, some of which were tariffs, including a 10% flat tariff on Canada, Mexico, and China, as well as he's thinking about a 25% plus tariff on both the automotive and semiconductor industries. Both sectors NVIDIA is heavily involved in. I think a large issue that could be impacting NVIDIA's stock price is the ethical landscape around AI. It's very controversial, and as consumer expectations change about AI, we're soon to see regulations following it, as regulations usually follow religion. So if NVIDIA wants to maintain their position as the leader and paint themselves in a good light. They'll have to practice rigorous and strict ethical practices. Another issue I see is the climate change awareness movement that's happening. This is a secular change that we've seen for a while now, including people going so far to boycott different companies that refuse to make a change. Currently, AI is one of the leading contributors to global warming, as it takes a lot of energy and water to run these servers, estimating about every 50 prompts that you send to an AI consumes about 1 bottle of water required to cool off the server. Finally, we have antitrust regulations. NVIDIA does have the US Department of Justice probing them for antitrust violations. Following Biden restricting the exports to China, China also opted to probe NVIDIA for antitrust violations in relation to the Mellanox acquisition that they did in 2023. And it's important to note here, it's not illegal to have a monopoly. It's only illegal if that monopoly uses its powers to harm consumers or to artificially restrict innovation. Neither of which I think are happening, but you never know. This may evolve and may escalate in the future, but at the moment, it's nothing to be concerned about. Google currently has 4 antitrust cases against them. It's not something to overlook. It's something to keep in mind, but it's not something that I see as being too serious. Next, we're going to look at the fundamental drivers into my optimism for NVIDIA and why I think that they're undervalued. So semiconductor and GPU sales are up year over year with a projection of 11.2% growth in 2025. The current market is growing at an abnormal rate of 22.75% year over year, which is much higher than its 10-year average of 11.35%. I would expect in 2025 to see a mean reversion, going more towards that 10% return on the market that we are used to seeing. GDP appears to be growing consistently since early 2000s, with a slight taper at 2022 due to anti-inflationary techniques. NVIDIA has a Pearson correlation coefficient of about 0.79 to the market, which is significantly lower than Microsoft and Amazon's correlation to the market of 0.97. Recently in the CPI, which is a lagging indicator of inflation in the United States, we see an uptick, which the Fed rate's already high, but may entice them to keep rates higher for longer or increase the rates in the future. We were originally planning on decreasing rates throughout 2025, but it looks like it might be easier said than done. According to Morningstar's index, the AI industry is generating a alpha of around 8% on top of the already abnormal 20%, 23% market return. I think this is largely due to the 2024 arms race that started due to Cursor, which is an AI platform where you can type in a prompt and it will auto code an entire project for you and build out the entire file structure that released in late 2023. This allowed entrepreneurs who had no technical skill in coding type in a prompt and build a web app in a weekend without hiring any graphic designers, without hiring any code developers. They could do it by themselves because AI was doing most of the heavy lifting. They just had to come up with the idea. So these entrepreneurs are always looking for the best AI that can handle these larger and more complex projects without making mistakes, which pushes these companies such as Google, OpenAI, and Meta to create better and better AI platforms to grab the entrepreneur's attention. It is to be noted how API systems work, where these entrepreneurs can basically swap out the model that their platform is using overnight, making that the switching cost very low, and they can freely switch between whichever model is performing the best at the time. Lastly, I see a fundamental driver of NVIDIA's growth being that they will maintain their full stack platform. It's paramount that they keep all their proprietary hardware and software privatized. NVIDIA has built this robust foundation over decades of research. And if they were to have any of this research leaked, that would give any of their competition, such as AMD, to get up to speed overnight. So they largely depend on this monopoly of knowledge, so that all their competitors need to reinvent the wheel, so to speak, to get to the same level of NVIDIA. Looking at the 10-year data of the S&P 500, we can see that the median PE ratio is 23.6 and its current PE ratio is 30.53. The PE ratio is price to earnings, which essentially means how much are you spending for $1 of profit. So in this case, for the S&P 500, you're spending $30 for every $1 of profit. This tells us that the price is outpacing earnings. If earnings was increasing with the price, we would see a consistent PE ratio. But because the PE ratio is getting larger, the price is growing faster than earnings. This tells us as it approaches its 10-year high of 38.23 that it's getting slowly more and more overpriced. And right now, compared to its 10-year median, it is currently overvalued and it's very expensive to buy into the market right now. For the tech sector, we see the same exact trend except exaggerated, which is expected due to the beta of the sector being 1.21. I would expect in 2025 to see a mean reversion heading back towards that median PE of 25.01. Here you can see all the sectors of the S&P 500, with the S&P 500 being at the top. Oddly enough, financials and utilities outpaced tech in the last 12 months. I think this is largely due to the Magnificent Seven doing so well within the tech and other tech giants falling, such as Intel reporting a loss of $18.75 billion in fiscal year 2024, which made their stock price dive 41.40%. I think losses of these larger tech companies are dragging down the industry as a whole, which is why we see other industries outpacing tech. For the part you've all been waiting for, the financial analysis, I'm going to hop over to my spreadsheets and walk through them with you. My 3-year projections are on par with consensus as far as my earnings per share. We can see my 3-year estimates are a little bit more bullish, as I believe NVIDIA will do a little bit better than what consensus believes. The part where I stray the most from consensus is my estimates for revenue. I estimate revenues to grow about 125%, whereas consensus believes that it'll grow about 112%. My 2025 estimates do incorporate the Q3 data released, and they are on track for 112% return for the year, although they just released the Blackwell chips, which I believe will boost their revenues even more than expected. My earnings per share is the same because I estimate an operating margin around 61%, whereas consensus believes that they're going to get an operating margin closer to 65%. In fiscal year of 2026, I believe that they're going to have a revenue growth of 130%, which consensus believes that they're going to experience a growth of 50%. I think it's going to be an even higher year due to the fact that this is an expansionary industry, and even if the economy goes into a slump, these data centers are going to be double downing on their increase their spending and try to expand as fast as possible. AI as an industry, because it is just now entering its growth stage and exiting the intro stage of the business life cycle, I believe could prop up the US economy as a whole, which is why I believe 2 years in the future, we're going to see a growth of 130%, and then I'll taper it off in my 3-year estimates. You'll notice that my earnings per share are yet again still on par with consensus. This is greatly because I am reducing the operating margin. I think NVIDIA is going to spend a lot more money to maintain their leadership position within the market, and they're going to spend more money to make more money. For fiscal year of 2027, I believe that the revenues will grow by 50%. I think it's going to cut back on the growth rate. Still going to be impressive growth, but cut back a little bit as the industry gets a little bit more mature. Again, I think NVIDIA is going to increase their research and development up to the historical average that they've been spending on research and development, just to maintain their advantage within this industry and make sure they have the most cutting edge product and stay ahead of AMD, Intel, and Microsoft. So next we're going to hop into my valuation methods, including valuation by multiples, my DCF model. I did adjust for the priciness of the market. So I did do a market adjustment, and then finally a weighted average of my estimates. So in this table, we have all the main competitors of NVIDIA, where I have listed out their multiples, such as PE, price to sales ratio, the price to book, and price to cash flow, as well as all their market caps. The competitor average for the PE ratio sits around 75, and NVIDIA is sitting at 54.82. This tells us that NVIDIA is relatively undervalued compared to the competitor average. So they do stand to, if they were to go to the mean, they would increase in value. Looking at the price to sales ratio, we can see a competitor average of 10.45, and NVIDIA sitting way above that at 30.48. That is extreme. There's a large discrepancy there, and you'll notice that for all these companies, there's a large difference between their price to earnings and their price to sales. This is because sales is the revenue, whereas earnings is their profits. So sales is not accounting for cost, whereas profits do account for the loss of money due to cost. So you can expect that the PE ratio to always be higher than the sales, because the denominator of the equation will be smaller than that of the price to sales. But you can see the price to earnings, the price to sales ratio difference is not too big for NVIDIA, and that's because of its profit margins are just so large compared to any of its competitors. So the fact that its price to sales ratio is so high above the competitor average is not a red flag to me. I think that's actually a pretty strong sign. So for my valuation by multiples, I chose a target value of the mean of the PE across the competitor average, which gives me a scalar once I divide the target multiple by the current multiple, and multiplying the current stock price by the scalar reveals the target price. I did that for all the multiples and I took an average of them. I'm not a huge fan of the multiple valuation method as I don't think it's that accurate, and also the market as a whole is overpriced. This is all subject to a price correction. Additionally, I think the price to book value is not a fair comparison for NVIDIA because they just recently experienced the cash flow explosion in 2023, and they've only had a year to really plan out what they want to do with their balance sheet, whereas all these other companies haven't experienced such rapid growth that NVIDIA has experienced. So they have had a decent amount of time to plan their balance sheets, and they have consistent income. For the discounted cash flow analysis, I calculated the WACC, or the weighted average cost of capital, to be about 12.56, which I used initially for my discount rate. With NVIDIA having a PE multiple of around 54, I looked on my implied ratio spreadsheet and found at a WACC of, say, 1250. I'll look for the closest thing to 54. So we can reasonably use a terminal growth rate of 10.5% to the 12.5 discount rate. What I ended up doing is trying two separate discount rates while varying the terminal growth rate between 10.25 and 10.5, and I did a sensitivity analysis across those four data points. Then I also calculated the free cash flow average, 10-year average being around 31% over the last 10 years, not including the most recent year in fiscal year 2024, where they saw the explosion in free cash flow. So using 31% as a theoretical terminal growth rate, I went on my applied spreadsheet, scrolled all the way over, all the way down until I found the 31 came over where it got me to 33.2. And so that is my starting point for this section. So 31% growth rate, starting with a discount rate of 33.25. The WACC is only 12.5. I did start moving towards the WACC in intervals of 0.25%, which reveals all these prices. So the way this works is that this is my DCF model. So you plug in these numbers, and then at the bottom here, you can see its projected implied equity per share. So I ran all these different combinations of the discount and growth rates, and I took an average of all of those to come to a valuation target of $173.92. And this is the value that I used moving forward. So when I got to this number, I wanted to adjust for the market being overpriced. I didn't want this potential upside of 30%, as I don't think that's honestly with investors' expectations of the market. It's not looking so reasonable. So by looking at the 10-year data of the S&P 500, I did the same thing that I did with the previous multiple valuation, where I took a target ratio of, which is just the median 10-year PE ratio. I divided the target ratio by the current ratio to get a scalar down here. And so I took the target price that we calculated from earlier, I multiplied it by the scalar, and we got a market adjusted price of $134.44. So I took a weighted average of this correction. I ended up putting a 77% emphasis on the adjusted price, which finally gives us a target value of $143.52, providing a theoretical upside of the 6.76%, which again, my final rating would be to buy this stock as it does appear to be undervalued. So given the potential upside of 6.76%, I would recommend to buy this stock. Again, invest at your own risk. I'm not to be held liable for any loss or gains that you make. I'm not your financial advisor, so please understand the risk of the investments that you take on, and just enjoy the process. Thank you so much for watching. If you found value in this video, please subscribe for more. I would love to do more of these. If you have a specific public company in mind that you would like for me to cover next, please holler at me. Let me know what you want to see. If you are someone who is hiring an analyst, please reach out to me. I would love to work something out. And thank you so much for watching. Have a great day.